Hello, dear viewers. Welcome to another episode of Investology, where we try to reconstruct everything investing and personal finance. We really hope at the end of this episode you would have learned something new about money, investing, and personal finance. Uh, to ensure that you don't miss our future episodes, please ensure that you subscribe. We have with us a special guest today, Saurabh Jain. Saurabh is MD and CEO of Navi Mutual Fund. Uh, Navi, if you don't already know, is Sachin Bansal's newest venture, the co-founder of Flipkart. Saurabh, before this role, was Sachin Bansal's chief of staff, uh, and he is an IIT Bombay alumnus. And previously, he was a senior leader at Swiggy, where he spearheaded Swiggy's expansion into 500 new cities in less than 2 years. And that today is one of the fastest expansion ever in the startup or corporate history of India. Welcome, Saurabh.
Hey, thanks, Abhilash. Thanks for the nice introduction. I think people must be confused that there is no finance background to all this. So
Yeah, that's like an interesting topic, right? How did that come about? How did you come to Navi, and how do you think about it without any finance background? Mutual funds. Mutual funds typically is an industry that is considered to be full of people, finance veterans, right? Don't think of mutual funds as a startup area usually. So how do you think about this? How did you end up with Navi, and how did Navi come about, and what's the whole vision?
Yeah, so actually, Navi just happened, right? I think one fine day I got a call and said that this is an opportunity to work with Sachin. And so rather than thinking too much about whether it's a fintech and what is really Navi planning to do, I just thought that maybe let me just meet him and understand. And then I think the series of events happened, and then I landed up in Navi. And since then, and my first apprehension when I joined Navi was also that, yeah, I really don't know anything about finance. Right? At that time, we were thinking of NBFCs, lending, we were thinking of general insurance, we were thinking of mutual fund banking, right? So I have absolutely no experience of that, right? Coming from engineering background, no MBA. But then once got into this role of chief of staff with Sachin, right, I think I realized that a lot of things are, if you think from a first principle point of view, I think there are a lot of questions that you can ask which will help you clarify the basics of it, right? And then I also realized there are a lot of assumptions that people have in this industry, that this is how it works because this is how it's been happening since the past, right? And having some startup experience of my own and Swiggy, that helped me to uncover that. And then since then it's been smooth. And what I'm also seeing right now with, I think you are close to this, right? With the fintechs, so many fintechs coming into this, so many startups coming into this, I think you will see more people who have no finance background getting into this, because it's more about really fundamentals, thinking about your customers, thinking about your investors, and building something that will work for a really long time. And the only thing that you really don't know, because you're not from the same background, is the regulatory constraint, right? And obviously you will have a team who can help you with that. So that's how it's been. Last 6 months were very what do you say, it was a roller coaster ride, a lot of new things to know. I'm sure, I think it's just the beginning.
I'm sure. So you raised an important point, first principle thinking. A lot of our viewers now might not have heard about this term, right? Can you really explain what is first principles thinking and why is it so important in today's world?
So I'll give you one example, right? How we are at Navi thinking about this, and maybe at Navi Mutual Fund we are thinking about this. So when I understood about this mutual fund market, right, I think when you build a fund, right, and to some examples of those fund for the viewers is like a large cap fund or a mid cap fund or a small cap fund or a debt fund or ETF and all of that, right? When you build these funds, I have seen a lot of these funds are created with some bias in mind, right? Saying that, hey, today in the industry, large cap will work really well. It'll garner larger AUM. right? So let me build something for that, right? Nobody is thinking that what this fund really has to do, right? This fund has to deliver a desired returns, not the highest returns, that desired return for an investor. Like Abhilash, you as an investor, you might not have a need of 25% return, right? You might just say that, hey, I'm investing 80-90% of my amount in FD, and I want something that can give me FD plus returns. So can you build a product for me that ways? So what we do when we are building products, and maybe we can cover that over time, is how we are thinking about product is we are really going to the investors, talking to those investors and asking them that what do they really want, right? And not in terms of, hey, I want a large cap fund or I want a retirement fund, in terms of what is your expectations from the money that you are investing. And backwards of that, we are building a product. And then once we have the understanding in terms of, hey, this is what the investor wants, and this is what it takes us to build that, then we see if this is possible, not possible, what are the constraint guardrails from the regulators, and then we try and fit that. But we don't start with the constraint first, saying that, hey, I can build a large cap in which X% will be large cap, X is like Y is mid cap, so it will give this much of return. So let's build this, right? So I think that's one example, and you will see a lot of that in our future products that will come in the subsequent months, right? I think these are some of these products are really unique products because we believe there is a large chunk of investors who wants that, and some of these products are already existing in the market, but we believe the way we will communicate that to the relevant investors will be very different.
That's very interesting, Saurabh. Keeping the investors, the customers at the center of your product, even before building the product, thinking about and going to the customers and asking, what do you want, right? And let me build a product to solve your pain point. That's, I think, the need of the hour. And I really wish everyone goes about building their products like that. We'll talk a little bit more about the products that you're building down the line. But today's topic is passive investing, right? And we want to kind of deconstruct that a little bit more. At Finity, passive investing is something that we are very, very passionate about. And we really think that for a lot of first-time investors, passive investing is the way to go. But the fact is, a lot of our investors are first-time investors in mutual funds. So let's try to deconstruct this a little bit. So what is active investing and passive investing, and how are they different?
Well, I think if you search active versus passive investing on Google, I think you'll get some 10,000 plus links and everybody's talking about that. But I think rather than saying passive investing, right, I heard a very interesting term about passive investments called humble investing, right? It's like passive fund is really a humble fund, right? So I'll tell you active versus passive. The basic difference between active and passive is that when you're looking into active fund, there is a fund manager who is deciding obviously in the guardrails, who is deciding which stock to buy, when to buy, when to sell, when to buy a new stock, right? So he's taking a call on the investment for your fund. So that's the one important thing. So it's driven by that person. So whatever calls he take, if it goes right, you get higher returns. If it doesn't go right, you get the impact of that. When you think of a passive fund is nothing but it follows a certain benchmark. Now, for the first time investors, benchmark is nothing but a rule that is being created by in the industry, which says that, hey, Nifty 50 is the benchmark that I want to create, which is all the top 50 stocks in the market, and you create a benchmark of that, right? And then any index fund, any passive fund which follows that benchmark is nothing but doing the investment in the same proportion of those benchmark, right? And there is no human involved, right? So currently, let's say there are some 50 stocks that are currently in Nifty 50. And after 3 months, there is a recalibration happens because these 50 stocks are nothing but top 50 market capitalized stocks in the market. So if there are some stocks which are going out of the mutual fund and there are few stocks coming in, then accordingly you go and add those stocks and remove some of the stocks which are out of the benchmark. So there is absolutely zero human intervention involved in that way. So though we call it a humble stock, it's also a little, what do you say, ruthless in terms of that. Because even if I feel that, hey, this particular stock will really do well in future, but when you are thinking of passive fund or benchmark, if that stock doesn't fall into top 50 market cap stock, it'll automatically go out. And you don't have any choice to still keep that stock in your passive fund. You will have to take that stock out and add the new stock. And because of that, there is zero intervention from a human side. And you just completely follow the rule that is being set by benchmark.
And why is that a good thing? Why is it a good thing to not intervene and chop and change your portfolio? Why is that a good thing for investors?
Because I personally believe that a collective wisdom is better than an individual wisdom, right? So, and stock market really works on a collective wisdom of so many people, and they have their different philosophy, and all of that is reflected in the stock prices, right? And if an individual is deciding, let's say, take a case of Yes Bank or DHFL, right? If they still believe that, hey, this will do really well and I want to hold on to this and all of that, and they can pretty much hold on to that in an active fund. There is no rule. You can't go back and ask saying that, hey, why are you holding Yes Bank in my fund? I don't want that, remove it, right? So it's like his own discretion. So in that ways, it might sometimes hurt you, it might benefit you also. So, but if you see over a longer period, right, I think if you also look at the results, like this by December 2020, as per the report, right, if you look at the 5-year return, 80% of the active funds underperform versus the benchmark, right? So as you go over a longer period of time, the call taken by human, right, does not hold to for such a long period, right? Because you see a cycle, right? Let's say I am a fund manager and I believe very strongly about a pharma sector. I'll have a higher weightage of pharma, but after a certain point of time, that'll go away, right? But maybe as a human, I might stick to that philosophy. No, yeah, pharma will do a little more, like, or even better. But when it comes to index or passive funds, I think it doesn't happen that way. If pharma stocks are out of the benchmark, you have to get rid of those. If they are inside the benchmark, you'll have to take that. So if somebody is really looking for a long-term investment, I think more often than not, you will see passive funds giving better returns than active funds. Yeah, Abhilash.
Hi, Saurabh. Sorry, there was a small interruption. I heard most of what you said. So the point is, the market as a collective knows better, right? And as a result, over a long period, you are taking out the human bias. And what you also mentioned was that because the individual bias is taken out, there are chances that particular, if it is a actively managed fund, that particular fund will do very well. There are chances that it will do worse than the index also. Got that. So what are some of the other things that makes a passive fund or a passive product attractive? Like, for example, does taking the human element out have an impact on the cost? Is that a big part of the decision making from an investor standpoint, why they should invest in passive products?
Yeah, so I think let's go back to the topic that we have, right? Like, who should really invest in passive? And I think there are two things that I believe investors should ask first. First is, if they have a time and energy to do all the research and select, hey, I want to invest in this active fund, right? If they have time or energy, then go ahead and investor can go ahead and do that. And second is about cost, because like as a lot of known investors in the market, they say, right, if you are looking for a long-term return, cost is a very important factor. And the most important cost for running an active fund is the cost of a human, right? The fund manager cost, the overall fund management cost is significantly high. But when it comes to passive, that cost is completely taken out. So hence, you will see that if on an average, the fee of running an active fund for like active direct fund is around 1%, you will see that for a passive fund will be somewhere around like 1/5 or 1/6 of that, or even lower in some cases. So that adds a significant value. And just to give you some number, right? So we were doing some maths when we were launching Nifty 50 funds. So if you do a 5 lakh investment in a Nifty 50 fund, which has a 6 basis point expense ratio, right? Like we have. And if that same amount, let's say you invest
Sorry,
in,
what is the basis point for the benefit of your viewers? If you could,
yeah, so basically 0.06%, if that is the annual fee that you give to the mutual fund to run that, right? So Navi Nifty 50 has a 0.06% fee, annual fee. And let's say there is an active fund which will give a same return as a Navi Nifty 50, but has a fee of 0.9%, right? So if you see 0.06%, 0.9% looks very small. But if you see for a 5 lakh investment over a 30-year, this could be the delta in the returns will be as high as 30 lakhs. Right. So there is a lot of this compounding effect that happens because of the cost, right? So, and that's what I said, right? If you are looking for a long-term return, I think lower the cost, higher the return. And that's where passive has an advantage over active funds.
Got that, Saurabh. So if an investor wants to add passive products to their portfolio, what are some of the options? What are the different products that come under the passive umbrella?
So there are broadly two categories in passive, right? And one of the categories is very new. So one is the index funds and other is the ETFs. So exchange traded funds, right? So ETFs are nothing but it is traded like a stock. So you have to have if you have a demat account, you can go on to one of your brokers and buy ETFs of Nifty 50 or whichever index funds you want to buy, right? So this is like a regular stock. And second is like an index fund, so which is nothing but the similar to the mutual fund, where you invest the money and you get the price of the end of the day. You can't do trading like a stock market. So these are the two things, two major products that exist in passive. And if you look at like how do we, and there are a lot of these questions that keeps coming to us, right? That whether when you're talking about passive, should I invest in ETF or should I invest in index fund? So there are a couple of things that we recommend to our investors, right? First is very basic. You have to see whether you have a demat account or not, because for ETFs you need a demat account. For mutual funds you don't need a demat account, and opening a demat account comes with some cost. So that's the base rule. Second is to do what are you investing for? So we are asking investors saying that, why do you want to get into ETF? Do you plan to buy and sell, track the stock market on a daily level and do like buy, sell on a regular level? Or you want to do this investment for a long term? So if you want to do this investment on a long term, right, we recommend them to go with an index fund, because you have an option of doing SIP and multiple such options, right, where you can do a systematic investment. That's not the options with ETF. But if you really are into stock market, track stock market, and you want to capture every up and down movement in stock market on a daily level, then ETFs are recommended. So these are some of the things that investors should consider before they decide on which passive product they want to buy.
Got that. So related to that question, Saurabh, so there are actively managed funds. Let's take index funds, right? There are actively managed funds and passively managed funds. If one of the questions that our viewers might be having is, why should I be investing in passive funds versus active funds? How do I think about this? If I were a first-time investor and I'm coming to you, Saurabh, and asking, Saurabh, so where should I invest? I want to invest for the long term. Where should I invest? How do I go about thinking active funds versus passive funds? What would your advice be?
Yeah, so I think the first important question is which fund to invest in, whether you should go for an active or passive. And the second question is, let's say you have decided which active or which passive fund you want to invest in, then you decide like which sector, which category I want to invest in. So let me answer the first question, right? So first question, when you are saying I'm a new to mutual fund investor, so what we generally ask investors is the first thing, right, which we spoke, is do you have time and energy to do research? Because deciding which fund to buy requires a lot of effort, and especially if it is an active fund. So it will require time, it will require you to do a lot of research and then decide which fund to invest in. So that is the first thing. If you have that, so that's one parameter you should consider. And second is about the cost. And if we if we get answer no as an answer for any one of these questions, or if investor has no as an answer for any one of these questions, right, I think they should go for a passive fund. That's a very like a simplistic formula, I would say. And let's say a first time mutual fund investor decide that, hey, I want to decide on a passive fund. Then which passive fund? I think this becomes very important, right? Because here you need to really understand like which category, which segment do you really believe in. So there are multiple categories in funds, right? As we spoke, large cap, which is nothing but the top 100 companies of India. Mid cap, which is next 150 companies in India, and then the rest are small cap. So these are different categories. Then you have different sectors also, right? There is an IT sector, there is a manufacturing, there is pharma, there is FMCG. So there are multiple sectors like that. And there are multiple indexes across this sector. So there are a lot of investors for the first time, they come and say that, hey, I really believe in that IT in India will grow really well. I want to invest in that. So that's one knowledge. But let's say if an investor doesn't understand that, hey, I don't have any preference for a sector, or I don't have any preference for a large cap, mid cap, small cap, we ask them to invest in a broader stock market. Let's say if you really don't know and this is your first, right, why don't you go and buy Nifty 500? So you actually buy all the 500 stock, which contributes to, I think, 97-98% of the entire stock market capitalization. That's what you should prefer. And you see that trend as well, right? In US, or I think the biggest global fund is nothing but the total US stock market fund by Vanguard, right? Which nothing but buys 3,000, 4,000 stocks of the US market, right? So it is no brainer. So let me just invest in the whole US stock market. So similar to that, if you really don't know which sector, I think you can go for a broader market. So that's the first thing you should consider. Second thing that you should consider is the cost, right? The fee that a mutual fund company like Navi is charging, right? Because there is no such differentiation between a Nifty 50 index fund by an AMCX versus an AMCY. So whoever is charging low, that will eventually give you higher returns, right? And we spoke about the impact can be as high as 30 lakhs over like a longer period. So that's the second thing that you should look at. And third thing that you should look at is nothing but the tracking error and the tracking difference. So these are little technical terms, but if I have to simplify, right? So tracking difference is nothing but my Nifty 50 index fund, the Navi Nifty 50 index fund is tracking Nifty 50 benchmark, which is being created. And the same benchmark is used by all the Nifty 50 index funds. So there are 15 Nifty 50 index fund. Everybody follows the same benchmark. And if Nifty 50 is delivering, let's say, X% returns, how much less or how much more return is your fund delivering? That is nothing but the tracking difference. And the consistency of delivering that return is nothing but the tracking error, right? Rather than going into technicalities. So these are the three things, like which sector, the cost of the fund, and the tracking difference, tracking error. These are the three things that people should look into. And this information is readily available on all the platforms that you can go. And you can, and an investor can take a call.
Got that. So one of our viewers, Karthikeyan D, is asking a question, and you partly answered that. I think there is a little more to it. How to diversify index? If I were an index fund investor, how do I diversify for the long term? If all my investments are put in, let's say, the index funds, how do you answer that?
I think it varies by investor, right? Like, for example, you need to have certain understanding of the market and say that, hey, do you believe that some of the, like we spoke about large cap, mid cap, and small cap, right? What is your understanding where the markets will, like where the large cap will go, where the small cap and mid cap will go? How is being the past performance of that? And the second thing is about the risk, right? Because risk is very important, and that varies investor by investor. And that's, I think, returns varies by different fund, but the risk doesn't. So risk is the one constant thing in mutual fund. And if you, like, we have seen how mutual fund investor really invest into the stock market, right? And so a lot of investors, when we ask them, how did you invest, let's say, on any particular platform? So they say, we went onto the platform, we looked at the top fund, we sorted by the returns, and whichever was giving the higher return, we invested into that. And more often than not, you will invest in a large cap, small cap, because that is where you will see a higher return, but that comes with a significantly higher risk. So I'm saying an investor needs to understand the risk of their own, like the risk and the appetite that they have, and then accordingly see which funds they want to invest into.
Right. Also, I would add to that, Saurabh, when an investor invests, for example, in the Nifty 50, one of the things, Karthikeyan, is Nifty 50 in essence is already diversified, right? Because it already has an FMCG stocks. It already has, infrastructure stocks. It already has technology stocks. So by investing in the larger benchmark, you essentially are diversifying, right? I mean, as a long-term investor, I would say that when you are investing in the index, especially the benchmark indices like the Nifty 50 or the Nifty Next 50 or the Sensex, you are diversifying your portfolio right then and there. And Annapurna is asking, aren't ETFs cheaper than index funds? Yes, ETFs are definitely cheaper than index funds. And apart from that, I think ETFs and index funds are more or less similar. And the other difference that Saurabh you mentioned is ETFs can be traded on a day-to-day basis, where real time you will be able to buy and sell, whereas index funds, it is end of day NAV like any other mutual fund that you will get.
Yeah.
Right. Cool, got that. So are there any other factors that investors should consider? Maybe we could go a little bit deeper into tracking error, right? Now Navi is a technology first company, and a tracking error is really how closely you are mimicking the performance of the index, right? And the lower your tracking error, the closer you are. And although you are mimicking the index, there is a certain amount of human effort in buying and selling at the correct time, so that the tracking. How does Navi tackle this tracking error problem, and is there a technology element to it?
Yeah. So what we also realize that in passive fund, we know that everybody is following the same benchmark. The cost will be more or less, you will see eventually will come closer, right? The differentiation will come with the tracking error, tracking difference. And currently how it happens, right, across all the mutual funds is there is still a fund manager for a passive fund who is not deciding which stocks to buy, but he's still taking a call like when to buy, how much money he has to keep in cash, right? So all those things, there is a lot of decision making that happens. And if you see that, right, when we observe what kind of decision a fund manager makes on the passive side, we believe that you can automate a lot of these things, right? You can automate saying that basis the inflows that a fund gets, the outflows that fund gets, right? You can decide that, hey, today I will invest this much amount, I will spread it across this half an hour to get closer to the market price, right? So and currently, like whatever limited understanding I have, nobody's really doing that. So we have made some efforts so far our Navi Nifty 50 as well. We are trying to automate some of these things, which is though I think tracking error, tracking difference, you will look it over a long period of time. But even whatever 1 month we have covered so far, we are getting a lot of encouraging results on that side. So that's one space we believe will make a lot of difference over a long period of time. So yeah, so we are not there yet, but we have started efforts on that.
That's good to hear, Saurabh. Recently Navi launched the Nifty 50 Index Fund, the first passive fund coming from the Navi stable, right? What has the experience been like so far? Any insights from the whole launch till now?
Oh, it's pretty. What do you say? I think a lot of things did not go as expected, right? And in a positive way. So, though we have got almost 17,000, 18,000 investors during the NFO period, our initial hypothesis that when we went to the market, right, we realized that passive fund, though it's a simple product, people generally consider this as a little complex. This is something which is automated and all of that, right? And we thought that the initial adopters to our Nifty 50 index funds will be people who have heard about passive fund, who understand, or who invest in passive fund somewhere else. But because we are the lowest expense ratio, they'll be the first one to come. And then slowly, as we educate more and more investor, first time mutual fund investor will start investing. But to our surprise, 40% of our investors are first-time mutual fund investors who are investing into passive fund. So that was a big surprise to us, right? And so when we went and actually spoke to a lot of those investors, they said that we heard about this fund and we did some basic research on that, some of the factors that are important, and we realized cost is one of the important factors, and we invested into this. So that was pretty interesting. And so yeah, I think that is one of the insights that we have. A lot of these investors, when we went and spoke to them, I think they are also kind of moving their active folios to us. So few of the investors they had large cap active funds, right? And they realized that most of the large cap active funds are not beating the benchmark. So they thought that rather than paying a high cost onto active funds, let me move that money into an index fund and keep it here for the long term. So these are some of the things. I think SIP is one important, what do you say, investment pattern that we are seeing. A lot of investors are doing a small ticket size, big ticket size SIP because it's very difficult to time the market, right? And for Nifty 50, we are saying that you'll have to keep doing this continuous investment. So most of our investments is coming from SIP. So these are some of the things that we learned, though it's just 1 month of the launch right now.
Awesome. I think congratulations once again on the collections of 100 plus crores, and I hope and wish that this grows multiple fold into and goes into the thousands very soon. But you mentioned it is a lot of active customers, investors who had active funds in their portfolio were moving their stocks, and one of the reasons is active funds were not beating especially the large cap funds. Were not beating the benchmark index. Why is that so? Why is it becoming more and more difficult for an active fund manager, especially in the large cap category, to beat the index?
See, I think what you will see is most of the large cap mutual fund investors, right? They are also kind of hugging the benchmark. So they are also saying that, hey, though I am running this actively, if Nifty 50 is the benchmark, they will also try and mimic that benchmark because that has been really outperforming. So that is one. But second is you also have some you will keep like few percentage in cash. So that by default tells you that your performance will be slightly lower than what the benchmark is doing. So that's one. Second is I think in like what I said, right? The benchmark is really brutal. There is absolutely, we are seeing a lot of stocks coming into the Nifty 50 benchmark, going out of the Nifty 50 benchmark and all of that. But when there is a human intervention, you will see that a lot of mutual fund managers will try and stick to their philosophy, and that might deliver results in short term or a long term. But yeah, in most of the cases, it is not. So that's why we see that only 80%, only 20% of the active funds are really beating the benchmark.
Interesting. And additionally, there is this whole aspect of cost as well, right? So like you said, the large cap funds typically, try to mimic the index because the index in itself is some of the best performing large cap funds that are out there. So they don't really have a lot of choice to maneuver there. And on top of that, there is a cost. And over a period of time, it becomes more and more difficult for these fund managers to beat the index. I mean, excellent point there. So Karthikeyan has another question as a follow-up. He's asking, if let's say I'm a long-term investor and I have a passive portfolio, is there scope for active funds as well? For example, small cap funds. Is that a way that investors can go?
No, absolutely. I think, like, I personally don't recommend that, hey, everybody put the entire allocation into the passive funds, right? There are still, if you see, there are only 20% of the mutual funds, let's say they are beating the benchmark. But the number of investors who are investing into those 20% could be higher, right? So there might be 30, 40% investors who are getting alpha on their returns. But for that, what you really have to do is you have to do a lot of work, research in terms of, hey, which is like who is performing, who is the fund manager, what's the history of that fund manager, what is the fund philosophy of that, what are the stocks that do they have, right? So I have seen a lot of active investors who do a lot of these research and come up with their limited stock, and they also churn it at a frequent level. and they keep getting alpha on that. So I'm sure there is some component that you can keep for your active funds as well. But for that, I really recommend investor that they do a thorough research. And I think, unlike in the old times, I think there is a lot of data readily available right now. So you can really look at the fund performance for the last 3 years, 5 years. What is the churn, the history of the fund manager before really investing into that. And there will be certain what do you say? There will be certain segment categories where the passive fund does not exist, but you really believe in that sector segment, which some of the active funds might give you higher exposure to. And absolutely, if you believe in that, that is the fund for you.
Got that. We'll take one more question before I have a very important question to ask. Akshay Rena is asking, when investing in NFOs, right? How do you go about assessing the risk of an NFO, considering the fact that there is very limited information available about the performance itself, because it's a NFO itself is like a new fund, right? There is no performance history. So how should investors go about while choosing to invest in NFOs? What are the things that they should consider?
This is very interesting. So I think generally when you look at active funds, right? So, and as we said, active fund depends on that fund manager, how he plans to do, what's the philosophy. And during NFO, a lot of these fund managers, they go and talk about their fund philosophy. But how it really translates into results is something only time tells, right? So, and that's where you will see that most of the investors, they try to avoid during subscribing to the NFO for an active fund. But when it comes to passive fund, right? Let's say Navi Nifty 50. And we also got this question, right? Why should I invest in the NFO? I don't know your performance, right? And what you really have to see is the performance of the benchmark, because what any passive funds will follow is the performance of the benchmark, and that exists. And we know that over the last 10 years or 15 years, now Nifty 50 TRI has given 12%, 14%, whatever is that return. And that will be not exactly the same, but very close to that is what you will get with this as well. Right. So when it comes to passive fund NFOs, I think investor really don't have to worry about how will it happen once you go live.
Got that, Saurabh. Navi is very exciting, right? Because it is a tech-first AMC, right? And so what can we expect from Navi? What are some of the product innovations that we can expect from Navi that is probably currently not there in the market?
Yeah, I think there are two major things that we believe, like any new AMC can add a value at. There is a lot of value to be in the mutual fund market for long, right? So legacy also has a lot of value. But any new mutual fund, I think we see there are two gaps. I think first gap is around the whole investor experience. We see, despite so many years of mutual fund, the investor experience of buying, selling this mutual fund, knowing the status of mutual fund, having the right access to the data, knowing the right terminologies, how to decide and everything, I think that is still lacking. And that is one place, and it's not like a one small problem. It's like multiple smaller problems that we have to solve to really make the customer experience better. So that's one thing that we are really working on, and that will be solved using technology, that will be solved using some of the setting up some of the processes internally, educating investors and all of that. So that's one area where we are working, and it'll take its own sweet time, right, to improve before people actually start realizing the value of that experience. And second is on the product side. We believe there is a lot of passive is a very simple product, but there is a lot of scope of innovation that exists, right? And as we talked about the first principle, right? And there are a lot of interesting ideas that we are working on, and you might see in next couple of months some of the products that we will file with the regulators will show that how differently we are thinking. But maybe I can give you one example, right? So we spoke to a lot of investors, and we realized that, hey, what do you really believe that which sector, which segment do you believe will really work over the next 10 years, 20 years, that you really want to invest in that growth today so that you get that result right? And there are a couple of interesting ideas which are coming in. Like a few people are saying that and we spoke to a few tier 2, tier 3 people, and they're saying that, hey, I use all the social media very frequently, right? And they've been doing good, and we know that a lot more people will get onto that, and they will control a lot of market, a lot of information that exists in the market, right? Can you have something for that? So can we create, and like a very random example is, can we create an index fund which has all the social media stocks under that? Then other interesting idea that, and you must have seen, right, of how electric vehicles is picking up in India, and we are thinking that, is there any product that we can create which will have underlying companies which are either into electric car, electric bike manufacturing, or related companies, right? Companies which provides batteries for them, lithium batteries and all of that, right? There are no such products which exist there, but we know a lot of investors and first time investors, like 25 to 40 kind of age, they believe that, hey, next 5-10 years will be for, like, the future of mobility will change completely, and can I invest into that right now? And there are a lot of such products which exist internationally, but in India we're lacking that, right? Because those are currently not fancy products like large cap, mid cap, flexi cap. So a second, like, the major effort is going on the product innovation on that side as well. So and we are really hoping that some of these products will do really well and will solve some of the needs that currently investors have, which is not fulfilled by the existing products.
That's amazing. Very interesting ideas there. So, for example, future mobility or an electric mobility index, is that index already there, or is that something that Navi or someone else will create? How does that work?
Yeah, so it doesn't exist, right? And that's what I told you. So what really we are doing is we are going and asking investors and coming back and see how we can now do this. So now we are in that stage in terms of, okay, there are some like 10, 15 ideas that we believe will really work. And how do we have to build this, right? Is there any constraint that we have? Do we have to work under certain guardrails? Is there any way of we can launch this product and still keep the cost very low for the investors? So I think that exercise is happening right now. But I'm sure, I think we'll find out a way in doing this.
Saurabh, these are exciting times, okay? And with companies like Navi, whose core focus is innovation and creating new products that are good for the investors, what products they want, let's launch that. I mean, I'm really excited about the future, and we definitely look forward to the next few months, next few years, and to see how things pan out. One last question, and this is something that we keep getting from investors, right? Markets are at an all-time high, and we are telling investors that passive investing is one of the best ways to go about investing for the long term. Is there a right time to invest? What happens if there is a market crash?
Yeah, I think if you ask me, sort of, what have you learned in these last 6 months, right? So I'll tell you, my dad is a stockbroker for last 20 years, right? And I have seen a lot of investors, how they try to time the market. And it's like, in at least that one data point with so many clients that he had, it never worked. So the one advice is never to time the market. I have seen people in the last 20 days who are my friends, family, or some of the investors saying that, hey, we don't want to invest right now because Nifty is at 1600, then it goes to 16,300, and they say, hey, I don't want to invest right now, and then it goes to 16,500. So it's very difficult to time the market, right? Because you really don't know what's happening. So the best way is that you systematically keep investing and you keep that money for a longer period, right? And you will get the returns that you want. It's very difficult to do that. And to be very honest, we see the inflows that we are getting on a daily level, despite the markets are high or low, we get a good inflows that are coming in. So people really do understand that, hey, there is no point of me spending so much time, energy into when to buy, when to sell, and all of that, right? Because you really can't do that very well. And even if you can do that, you can do it once, twice, maybe you can't do that consistently. So if you want to take off that load, I think just have a systematic investment plan and just keep investing. Don't worry where the stock markets are. I think that's the problem with now so much of data also, right? People are having access to index and all of that on their fingertips, right? So they see, acha bad gaya, kam ho gaya, what should I do? That's the only advantage I see of the technology.
Super.
Sorry.
So the point is, index it and forget it if you want to go long term, right? Amazing. So thanks so much, Saurabh. I really, really enjoyed this conversation, and I'm going by the comments that I see. Looks like our viewers also enjoyed the conversation. Dear viewers, thanks so much for tuning in, and I really hope you learned something about investing, personal finance, markets, passive investing, through this session. And if to get more such sessions, make sure that you subscribe. And thank you so much, Saurabh. Any parting comments, thoughts to our viewers?
No, thank you so much, Abhilash. Thanks to you, Finity, for arranging this, and thanks to all the viewers for joining this.
Great. Entirely our pleasure, Saurabh. Thanks so much, viewers. Take care. Have a good day.
Bye.
Bye.